What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today we'll talk about how taxes work here in the US. About a week ago, I was talking to my friends about filing taxes. I don't know why the topic came up, but anyway, one of my friends was talking about how she could follow all of the directions on, say like a TurboTax or an H&R Block website or something like that, but she wouldn't really understand why things work or what the tax software was doing. So that got me thinking about taxes and really, whether or not there are any misconceptions about that. So I thought it'd be a really great topic to dive into a little bit here. So what we'll do today is look at federal taxes and how they work and how do our tax returns work as well. So first of all, what is a tax, right? It's a compulsory contribution to revenue, state revenue, levied by the government on workers' income or business profits or added on to goods and services. And of course, there's this kind of contention out there that believes that taxation is theft and all this stuff. And, I kind of get it. Like, you never made an agreement with the federal government that you would be paying X amount of your earnings as taxes. Sure, but, also you've been benefiting from all of the things that those taxes are doing for you. And you're welcome to, find citizenship somewhere else as well. So there is that possibility. In fact, I recently renounced my Mexican citizenship, and I'm now just a citizen of the United States. I had been dual, and one of the reasons was for tax reasons. If I wanted to live there, they don't recognize Roth accounts, and so that would have been actually a tax penalty. And I have no interest in owning property in Mexico. So anyway, basically, we have options if we really want to not pay taxes. I don't recommend going the Wesley Snipes route. That didn't seem to work out too well for him, or Nick Cage as well. He had to put out a lot of junky movies in order to try to get his tax liability paid. But why do we pay these taxes? And essentially, this comes down to some pretty basic macroeconomic econ 101 kind of stuff. But it's for the provision of public goods and also to solve the tragedy of the commons. So there's just a whole lot of stuff that our individual self-oriented actions are just not going to take care of. There's a lot of societal goods that we're just not going to be able to have if we don't set up an entity that's going to take care of that stuff for us, which is government. So things like having police and a fire department and roads and defense and subsidizing other things that do societal good that we would like basic research. Big ones also education, right? So there are all these things that are a tremendous public good that the private sector would never ever go about doing, and certainly would not do in a way that is equitable. Right. So that's why we pay taxes, and whether or not you think the level of taxation, yada yada, what have you, that's a personal thing. But I'm happy to pay my taxes for the things that the government does for me, even though exactly how that budget is outlined may not be exactly ideally in line with my values and what I think that maybe they should be doing. But anyway, that's what we can go out and vote and try to affect change over time. All right, so anyway, basically there's going to be taxes on us whenever we make money. So how do we go about paying these taxes? Well, it's pretty easy in the case of a wage earner, because those get automatically, we have some withholdings that come out. And so instead of having this giant tax bill at the end of the year, then most W-2 employees, that's regular like salary or part-time employees, are going to have some withholdings, so that there's some money being taken out in order to meet that tax liability at the end of the year as you go along, and you don't have this big nasty surprise. That is the most common case. We also have workers that are like 1099 independent contractors, so things like real estate agents or freelance workers, what have you. In these cases, you need to be careful on your own to be putting money aside in order to pay those taxes. A common rule of thumb is to put 30% of your gross earnings, put that on the side in order to meet your tax obligations. And then in those cases, we have to make quarterly estimated tax payments as well. So these withholdings, as we get paid, with each paycheck, and then also for independent contractors, our estimated quarterly tax payments, all these things are really just an estimate to try to not have a giant bill come tax time. But when we actually figure out what we owe, that's when we do our annual tax return, which is due by mid-April. So that's what we'll look at today, really figure out kind of what the idea is behind the tax return and how all that works. But of course, we'll be talking about in generalities for the simple case here, because the tax code is not all that simple, unfortunately, or fortunately, depending on whether or not you can take advantage of those interesting items in the tax code. But the basic idea is that you have your gross income. This is all of the income from all sources that you earn throughout the year, the taxable year, right? So that's going to be one full calendar year. And then there are, of course, a lot of deductions. So there are activities that we want to incentivize as a society. One of those things is saving for retirement. And so things like traditional IRA and traditional 401k contributions are deductible, so you can reduce your gross income by that amount, and you're not taxed on that amount of your income. So let's say that you're able to contribute $10,000 to a traditional 401k, and your wages were $50,000. Well, now you're only going to pay taxes on $40,000, that kind of a thing. So a lot of the point of the tax return system is to, one, put in all of your income from all your sources. That's going to be all your different forms, like your 1099 div and 1099 int, showing your dividend and capital gains and interest income. And then, of course, your W-2s. So now they have an idea of, okay, this is the total income that we got and what kind. And then the next part is to figure out what are all the deductions. So how much can we reduce our tax liability by to figure out how much we actually owe the IRS. On top of the traditional retirement account contributions we talked about, the other big one is, of course, the standard deduction. And the standard deduction has gotten really quite big in recent years. Has expanded during the Trump administration, and so it's become a lot less common that you'd actually want to itemize. So there are all kinds of different little things that you can try to deduct from your taxes, but it's pretty hard now to get beyond the $12,500 standard deduction for a single person, for instance. All right, so after all these adjustments, we come up with what our actual taxable income is going to be. And then the amount that we owe in taxes is based upon our progressive tax system. And basically what I mean by progressive is that the more well-off an individual or a household is, the more they're going to be asked to contribute towards society in the form of their taxes. In other words, the people that are most able to also do contribute the most. In theory, there are a lot of tax loopholes and whatnot, but that's the idea behind the marginal tax rate system. So why don't we do an example just to kind of flesh out how that works, because there's a real misunderstanding out there when it comes to these tax brackets, where people will sometimes think that moving into the next tax bracket is somehow a bad thing. That's not true. It doesn't retroactively take away income that you earned in the previous tax brackets. All it's going to do is it means that for the additional dollars that you get, this is what marginal means, you're going to get to keep a little bit less of them because you'll have to pay more taxes on those dollars. But it doesn't screw up all the other dollars that you earned up to that tax bracket. So let's take a look at an example and see how that works. And we'll look at the median income earner here in the US. So the median income earner earns $54,132. Let's assume that they put in, I think it's 15% into their 401k. That'll be $8,119.80. That's an amount that we can take right off the top because they're not going to be taxed on that. And we can add the $12,950 standard deduction as well. And so that leaves us with taxable income of $33,062. All right, so that's the amount of income that we're actually going to be taxed upon. And then we have all of these different brackets. The first bracket goes from $0 to $10,275. And on that income, we're taxed at the rate of 10%. Then we've got another bracket from $10,275 to $41,775. And that has a 12% tax rate. So the way that it doesn't work, which some people think it does, is that you find out, okay, I've got an income of $54,000. Well, I'm going to be in a tax bracket that applies to that, which actually in this case would be the $41,775 to $89,075 tax bracket, which is taxed at the rate of 22%. People might think that you fall into that, but that wouldn't make any sense at all because, well, then you might get taxed so heavily that it would make more sense to have a lower income, especially if you're kind of right near the threshold between the two. So that is not at all the way that it works. The way that it works is this. We fill up the buckets as we go along. So we're going to fill up first the $0 to $10,275 bucket. So the first $10,275 of our taxable income, the $33,000 goes into this bucket and we'll pay 10% on that. So that's going to be tax due of $1,028. And then the balance, so we take the $10,275 out of our taxable income. The amount that we have left to go into the next bucket is $22,787. So on that $22,787, we're taxed according to the next tax rate in the next tax bracket. That's 12%. And so we'll owe another $2,734 on that. So my total tax due is going to be $3,762, which is only 6.9%, so less than 7% of my gross income of $54,000. And again, this is in large part because I made a good contribution to my traditional 401k, and then also thanks to that very large standard deduction that we have these days. But again, it would be absolutely worth my while to earn more money, because for any extra dollar that I earn, yeah, I'll have to pay the 12% tax on that, because that's the new tax bracket that I'm in, but I'll still get to keep the other 88 cents of that dollar. So hopefully that made sense for you. And then what happens, of course, when we actually file our return, in most cases, people end up having a tax refund because the amount of the withholdings that they had and was more than enough to cover their tax bill. And so once we calculate all of these deductions and what their actual tax bill is, it ends up being less than they've already paid, and so they get a refund. So again, this is a refund. We're getting our money back. It is not like magic money coming out of nowhere. And so what it really means is that if we're getting large, consistent refunds, then maybe our withholdings aren't right. And we can adjust our withholdings down in order to get a smaller refund, which means we have more money throughout the year in order to invest and thereby earn some money, because the IRS isn't paying us any interest on the money that we've essentially loaned them that they're going to be refunding us later. However, you don't want to go too far the other way, or there can be penalties for having too large of a tax bill, basically not having made enough payments throughout the year. And so it is kind of a balance and kind of a more advanced thing to work out. Also, especially for people that don't have a whole lot of discipline in terms of savings, the tax refund can be a great form of forced savings. So by having these high withholdings, having this money that's kind of out of sight, out of mind, but you're going to get a nice refund at tax time, that is a common strategy that I see out there. For someone like myself, it just doesn't make a lot of sense, but I can see why these kinds of tools of forced savings can be useful to some people. But again, it is a refund. That's you getting your money back that you have already paid, that you did not in fact owe the IRS. So that's federal income taxes and tax returns in a nutshell. Hopefully that was helpful. I thought it would be helpful. If you thought so, please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.